Most people believe markets react to bad news. A headline appears, debt is rising, deficits widen, numbers look alarming. And the natural conclusion is that something must be wrong, that a mistake has been made, a failure is unfolding, or a crisis is approaching. But markets rarely respond to what is obvious. They respond to what is misunderstood. For decades, government debt has been discussed as if it were a temporary problem waiting to be fixed, something that should eventually be paid down, reduced, or eliminated. That framing feels intuitive. After all, households aim to pay off debt. Businesses aim to clean up their balance sheets. So it feels reasonable to assume governments should do the same. Yet despite constant concern, government debt has continued to grow across nearly every major economy. Not just during crises, but during periods of expansion as well. Different political systems, different ideologies, different decades, similar outcomes. That persistence raises an important question. What if rising debt is not primarily a policy failure, but a structural feature of the modern financial system? What if markets are not focused on whether debt is too high, but on whether the mechanisms that support it continue to function? And what if the real risk is not the size of the numbers themselves, but a misunderstanding of how those numbers interact with money, institutions, and incentives? That is where the analysis needs to begin. Over the past several decades, government debt levels have increased steadily across most major economies. In the United States, total federal debt has risen from under $6 trillion in the early 2000s to approximately $38 trillion today. It accumulated through repeated budget deficits, emergency spending during recessions, and ongoing structural gaps. Japan's government debt reached roughly $1,300 trillion, or more than 250% of its GDP, held largely by domestic institutions. Combined sovereign debt across major European economies now exceeds $14 trillion following years of expansion. Globally, total debt, including government, corporate, and household borrowing, has grown to approximately $315 trillion. This figure is about 3 times global GDP, reflecting decades of expanding credit across both public and private sectors. This increase hasn't been limited to crisis periods. Even during years of growth, debt levels have generally continued to rise. Governments roll over existing obligations to fund operations, social programs, and infrastructure. Ownership is widely distributed across pension funds, insurance companies, and central banks. The absolute scale has grown large enough to prompt renewed debate about sustainability and long-term risk. These are the observable facts. No interpretation is required to confirm them. The significance of rising government debt is not found in the headline number itself. It lies in how that debt interacts with the broader financial system and how changes in one area create second-order effects elsewhere. At the first order, government debt functions as a foundational asset. Sovereign bonds are widely used as collateral, as benchmark risk-free rates, and as core holdings for pension funds, insurance companies, and banks. These institutions rely on government debt not for speculation, but for stability, liquidity, and regulatory compliance. As debt issuance increases, it expands the supply of assets that the financial system uses to function. At the second order, the servicing of that debt creates predictable cash flows. Governments collect taxes and issue new debt. Interest payments flow to bondholders. Bondholders reinvest or distribute income to retirees, policyholders, and investors. This circular movement of funds is deeply embedded in the structure of modern economies. Interruptions to it, whether through disorderly defaults or sudden funding gaps, tend to transmit stress rapidly across institutions rather than remain isolated. This explains why policymakers often prioritize continuity over resolution. Reducing debt abruptly would not only affect government balance sheets, it would also reduce the supply of safe assets, tighten collateral availability, and disrupt funding markets. As a result, debt management has increasingly focused on refinancing, maturity extension, and rate management rather than outright elimination. Another important dynamic is the interaction between government debt and monetary policy. Central banks use sovereign bonds in open market operations, liquidity provision, and balance sheet management. When central banks purchase government bonds, they are not erasing obligations. They are altering who holds them and how liquidity is distributed within the system. This changes incentives for banks, investors, and governments simultaneously. The groups most immediately affected by these dynamics are institutional holders. Pension systems depend on predictable bond income, banks depend on sovereign bonds for liquidity buffers. Insurance companies depend on them to match long-term liabilities. These institutions are not positioned to absorb sudden structural changes without broader consequences for employment, retirement income, and credit availability. For households and businesses, the effects are indirect but persistent. Government borrowing influences interest rates, inflation dynamics, and fiscal flexibility. Over time, higher debt levels can limit policy choices, especially during downturns, as more resources are allocated to servicing existing obligations. None of this implies an imminent crisis. It does suggest that government debt is no longer merely a fiscal variable. It has become a systemic component of financial stability. Understanding this helps explain why markets often react less to rising debt itself and more to signals that the mechanisms supporting it may be changing. This distinction is essential for interpreting risk rationally rather than emotionally. Rather than reacting to headlines or large aggregate numbers, I focus on indicators that reflect stress, liquidity, and confidence within the system. These signals tend to change before outcomes become obvious. One of the most important is the U.S. Dollar Index, DXY. Sustained dollar strength often tightens global financial conditions, particularly for countries and institutions with dollar-denominated liabilities. A rapidly rising dollar can amplify funding stress, while a stable or weakening dollar tends to ease pressure across global markets. Treasury yields, especially at the long end of the curve, are another key signal. Rising yields driven by growth expectations differ materially from rising yields driven by inflation risk or credibility concerns. The distinction matters. I watch not just the level of yields, but the reason they are moving, reflected in break-even inflation rates and real yields. Inflation data, including CPI and PCE, remains central, not because inflation alone determines outcomes, but because it influences policy flexibility. Persistent deviations from target constrain central banks' ability to support markets during stress. Anchored expectations, by contrast, preserve optionality. Liquidity indicators are equally important. Measures such as bid-ask spreads in government bond markets, repo market conditions, and funding rates offer insight into how smoothly the system is functioning beneath the surface. Deterioration here often precedes broader volatility. I also monitor positioning and open interest in rates and currency markets. Extreme positioning can increase sensitivity to shocks, even when fundamentals appear stable. When leverage builds in one direction, small surprises can have outsized effects. Finally, fiscal signals matter, not in isolation, but in trajectory. Changes in issuance patterns, maturity profiles, and budget composition provide context for how governments are managing obligations over time. None of these indicators, on their own, tell a complete story. Together, they help distinguish between noise and structural change. The goal is not to predict a single outcome, but to understand whether the system is absorbing pressure or quietly accumulating it. Periods of elevated government debt are not unique to the present. History shows multiple episodes where debt levels rose sharply, often in response to war, financial crisis, or large structural transitions. Examining these periods helps reduce emotional bias, not by predicting outcomes, but by clarifying what tends to matter most before outcomes become visible. One frequently cited parallel is the aftermath of major wars. Following the Napoleonic Wars in the early 19th century, Britain's government debt exceeded 250% of GDP. Similarly, after World War II, debt levels in the United States and several European countries reached historic highs. In both cases, the immediate concern was not elimination of debt, but stabilization of the financial system and economic recovery. What followed was not uniform austerity or default. Instead, governments relied on a combination of economic growth, moderate inflation, financial repression, and long maturities to gradually reduce debt ratios over time. The nominal debt often remained large, but its relative burden declined as economies expanded. Another relevant episode is the 1970s and early 1980s, when high inflation altered the real value of outstanding debt while interest rates adjusted sharply. That period demonstrated how shifts in monetary policy can change debt dynamics quickly, not by eliminating obligations, but by redistributing costs across borrowers, lenders, and governments. More recently, the global financial crisis of 2008 and the pandemic period of 2020-2021 led to rapid debt accumulation across advanced economies. Central banks expanded their balance sheets, governments issued large volumes of debt, and financial markets adapted to higher levels of public borrowing without immediate loss of confidence. What is different this time is the starting point. Debt levels are already elevated, populations are aging, and long-term growth rates are lower than in past post-war recoveries. At the same time, financial systems are more interconnected, and sovereign bonds play a larger role in regulatory frameworks and institutional portfolios than in earlier eras. What is similar is the policy approach. Historically, governments have favored gradual adjustment over abrupt resolution. Debt has been managed through time, growth, and institutional coordination rather than through large-scale repayment or default. The historical record suggests that high debt alone does not dictate outcomes. What matters more is the surrounding structure: growth capacity, monetary credibility, institutional trust, and the ability to adapt. History, in this sense, is not a forecast. It is a filter, helping distinguish between structural challenges and immediate threats. Government debt is often discussed in absolute terms, large numbers that feel alarming in isolation. But markets do not operate in isolation. They function through relationships between borrowers and lenders, institutions and policy, confidence and liquidity. The purpose of analysis is not to dramatize those numbers nor to dismiss them. It is to understand how they fit into a system that has evolved over decades and continues to adapt. History shows that elevated debt can persist for long periods without immediate crisis, while also imposing real constraints that shape future choices. What matters most is not whether debt is high, but whether the mechanisms supporting it remain credible and flexible. That is where risk accumulates, and where it can also be managed. This isn't investment advice. It's simply how I'm reading the market right now. Risk management, patience, and long-term perspective matter more than reacting to fear or certainty. In complex systems, discipline is often the most undervalued asset of all.